All right, so you're interested in learning how to day trade options, but maybe feeling a little bit overwhelmed with all the information out there. So this video is here to help simplify all that, and we're just going to be talking about the basics of how to get started with day trading options. So let's dive right into it. So the first thing you're going to need to look at is this thing right here is called your options chain. So every broker has one, or most brokers should have one. And basically this is going to be where you're going to be looking at all the strikes and the data that you need in order to execute your options trades. So in this particular case, I am using Interactive Brokers, and they include what's called an options trader so that you can actually place your orders within the options chain. Depending on your broker, it may look a little different to you, but generally it's going to look pretty much the same in terms of the options chain. So first thing you really need to know is basically what strike price you're going to use and the expiration date. Those are basically the two things you need to know before placing a trade, right? So depending on your style in terms of expiration date, so if you're doing a 0 or same day expiration, or let's say 1 or 2 days, the shorter period the expiration is, the shorter time frame you want to be trading on. So let's say you're a scalper and you trade very quickly and you're just looking to capitalize on those quick volatile moves. For example, let's look at say on Tesla. So let's say you wanted to short Tesla here into this supply zone, into this 720s, and wanted to catch a nice quick profit here in this downswing. So in this case, taking a 0 day till expiration, let's say you traded it on Friday and you took those same day expirations, that would make sense because you don't intend on holding this thing, all day. So, taking those will not really affect your theta, which is time decay. So time decay is not going to be really a cause for concern if you're a day trader slash scalper, unless you're holding for several hours and intend to hold a same day expiration up until, say, the afternoon or the close, because that's when theta can really eat away at your contracts. So in this case, if you're a scalper, it definitely makes sense to take, same day or 1 day or 2 day expirations, because you're going to be in and out so quickly that the time decay is not going to impact your trade much. Now, let's say you had a bigger picture thesis on Tesla and you were planning on holding this thing all day or maybe for several hours today, or on Friday, sorry. In that case, you'd go with the 1 week or even 2 week expirations just to give yourself that bit of room so that you don't have that time against you. So the more time you have, yes, the less volatile the contracts will be, but also allows you to stay in the position longer without having to worry about that time decay creeping up on you and eating away at your contracts. So let's go over a trade example here on Tesla. Let's say we were taking a trade on it on Friday, and I'll show you guys exactly what I would choose, what contracts I would pick, what strike price, and why I would choose that strike price. So now let's say I wanted to short into this pop to resistance, and I wanted to get in, let's say around 715. So normally I would go at the money. I would look for a strike price that's near or at my price, my intended price of execution. So 715 is my intended price of entry. I would look for 715 strikes, sorry. And if we look at the puts here, they look pretty good aside from one thing, the volume. So the volume is probably the most important thing I look for when choosing my strike price. And if there's a more favorable volume on a different strike price, I would rather choose that over the, at the money strike price. Now, normally the stock, the at the money strike prices are pretty good volume, but in this case, it seemed to be a bit low. So I would definitely rather go for these 700 strikes because, as you can see, the volume is much greater and you have much better chance of getting filled at a better price, and the spreads are much tighter, therefore better execution. So the last thing you want is slippage and liquidity issues when you're trading options. Even if you're not trading that many contracts, it's still much more desirable to be trading high volume contracts because you're much more likely to get better fills, in my opinion. So let's say in this case, I would decide to choose the 700 puts, and let's take a look at how they move in relation to the actual underlying asset, in this case, Tesla. So as we can see, if we got short, or let's say if we bought puts into this move, let's say we got filled around 25 bucks per contract here. So we got filled at 25. It made a nice move all the way up to 35 if you held it all the way down to this break of the pivot new lows. So that's a $10 per share move. That's roughly 40% gain, and that's pretty awesome, right? But let's say, for example, we decided to go with these lower volume contracts that were at the money at the time. Let's take a look at how the chart looks. So as you can see, the chart looks pretty much identical except for one thing. The volume's obviously much lower, right? Now, there is also another difference. If you notice, because of the premiums, the price of the contracts were a little higher on these puts, on this strike price. The move is still $10 per share, but it's a 30% move instead of a 40% move now. And as you can see, we went from, let's say 32, let's say we got long, and it went up to 42 bucks. So same $10 move, but because the premiums were a higher price, the percentage gain is 10% smaller than the 700 strikes. So the thing with going out of the money like these 700 strikes, so at the time, if you're taking that trade and you're taking the 700 puts, yes, you are out of the money, but you need to understand how the underlying asset moves and understand the ATR, so the average trading range for the day on Tesla. And if any of you guys have watched Tesla, you know that a 10 or 20 point move is not very much, and it's pretty easy to do for Tesla. So in this case, it makes sense to go out of the money and target those 700 puts. So, taking these 700 puts made much more sense to me in this scenario, because I know that Tesla is capable of definitely making that move. And also because I know that 700 is definitely a magnet area, not only a psychological level, but it was a daily chart level, important daily chart level that was getting bought up previously. So it was a previous support level. So we know it's a magnet area, and we know that traders are likely to gravitate towards it, and their orders are going to be sitting there, whether it's a buy order or a short order. So it's an important area, and that's all that really matters. So you know that it's likely to get tested, at least to get tested that day. So now let's look at delta. So what is delta? Delta basically gives you an idea of how volatile the contracts are going to be in relation to the underlying asset. So essentially, delta tells you, how many cents per share or per contract the contracts are going to move for every dollar per share that the underlying asset moves. So in this scenario, let's say, so we saw Tesla, it went from 715 and it dropped to a low of, let's say we got out at 695. So let's say our target was just below 700, so we get out 695. So we can actually calculate what kind of gains we can expect on the contracts by looking at the delta of those contracts. So in this case, they were 50 cents per contract, the delta. So it's very simple. All you would do is take the move that Tesla made. So it went from 715 to 795. That's a 20 point move, right? So 20 bucks per share, times that by 50 cents a share, you get $10 per share. And as we can see, it basically made a $10 per share move. So right on the money. Now to calculate your risk, you do the same thing, but you'd calculate your risk level on the underlying asset. So let's say we got in 715 here again, and we're risking 720 because we know that's a supply zone on the daily and the bigger time frames. So if we're risking 5 points per share, we can calculate our risk based on the delta the same way. So we can take $5 per share times the 50 cents, and you're basically going to be risking $2.50 per contract. So let's say you're a trader who risks, let's just say $500 per trade. So you want to risk $500 on this trade. So you open up a trade, and now you're trying to decide how many contracts you need to buy in order to risk $500. So we know that we're going to be risking roughly $2.50 on the contracts. So if we see that the contract price, if we scroll here, if we see that we're going to get in roughly around 25 bucks, and we see the pivot low here for our risk is around 23 bucks, we know that we can say, okay, well, I'm going to probably be able to take maybe only one contract here because I want to risk, or sorry, 2 contracts because I want to risk roughly 500 bucks. So, one contract would be you'd be risking around $2 a share here, $2.50 a share here. So one contract would be roughly, $200. So if you want to risk 500, you take roughly for two contracts, sorry. So you take two contracts there and you know your risk now, and you have a very clear risk, and you're comfortable with the risk because you know that the most you'll be able to lose is probably 500 bucks. So even if you get a little bit of slippage and the contracts go below that pivot and you're unable to get out exactly at that price, because you took the proper amount of contracts, you're going to be well within your risk tolerance for that trade if it goes against you. So that's the simplest way to calculate your risk on contracts. It's not as complicated as it seems, but when you're beginning and starting to get into options trading, I know it can be a little overwhelming. I know for myself it was. So this video hopefully will help kind of explain that and kind of make it simple for you guys to get started with options. So let's talk a little bit more about expiry dates, and if we can go to, so for example, Tesla has weekly expirations. So they don't do dailies or every 2 or 3 days like some other underlying assets do. But if we take a look at, let's say we take a look at SPY, pull up SPY here. So SPY actually, their contracts expire every 3 days, I believe, or every 2 days. So you got Monday, Wednesdays, and Fridays for the SPY. So you have a choice to choose. You can trade either 1 day expirations, you can trade 1 week expirations. And typically when I'm day trading SPY, I can choose either from 1 or 3 days expiration. And what I find is choosing same day expirations are pretty volatile. So if you're choosing a same day expiration, I would suggest only doing that if you're going to be scalping very quickly and you don't intend on holding your position for a few hours, or nothing more than a few minutes at the most. So if we looked at SPY on Friday here, it was kind of just I think it was just kind of range bound. It had a nice morning sell-off here under those 393s, and then it kind of just consolidated in a range here basically, right? So 390s up to 393s, 392s. We consolidated basically in a range pretty much all day. So in this case, choosing same day expiration, it would be fine if you're taking, let's say for example, you're taking this break of this support level at the open, kind of this opening range breakout. Let's say you took those 393 break and you just scalped it out for a quick profit into this 390 support zone. That's totally fine if you're taking the 0 DTE, day till expirations. That's totally fine. But if you intend on holding SPY for a few hours or even overnight, swing trading, that's another topic. But for day trading, even if you're holding it for a few hours, I would recommend choosing a longer time frame for the expiration. So go with the 3 days or the 5 days instead of the 1 day or the 0 day. And you'll be much better off, so you can sit through that volatility and hold your position much longer, and the time decay won't catch up to you. So as you can see on SPY, it's one of the most liquid traded options on the market, and as you can see, the volume is pretty fantastic on pretty much any strike you choose. In this case today, the 390s puts had the most volume, and it's no surprise they held 390 because most of the volume was traded there, right? So let's go through another trade example again, this time on the SPY. So let's say we were going to take that 393 break on Friday, and let's look at the 393 strikes. Okay, so the 393 strikes, so basically we would have entered right around here. So let's say around 375, and the contracts went all the way up to let's say 520. So that's a pretty solid move, if you ask me. And that would be in this case, this would be on the Monday expiration. So had you taken the trade on Friday, this would have been a 3-day expiration. So as you can see, still very volatile, even when you're choosing expiration days that are not same day or 1 day. You can still get some great volatility in options and have better risk reward when you're trading those longer time frame expirations. So in this scenario, it would have made sense for me to choose the at the money strikes because they are liquid enough, they have enough volume, and they're going to be just as volatile as the as the let's say if I were to choose out of the money and choose the 390 puts, which would be the target, which would be my target for the day. So not only are they good volume, but as you can see, the delta is actually greater on them. So they're moving 70 cents per every dollar per share that the SPY moves. So as you can see, if we took this trade under 393, we got a roughly 3-point move. So that's $2.10 per share, right? So let's say we got in roughly around 380 here, and the contracts move up to roughly 520, 525. So it's about $1.40 per share. So that's about 2 times the delta here. And if we look at the price of SPY, it kind of moved roughly $2.50 from that entry. So if we got in, let's say at the break of this level, let's say 392.90, it dropped all the way down to roughly 390.20. So yeah, roughly about a $2.50, $2.60 a share move. So that makes sense when you add it up. Now, if we took the 390 puts instead, let's take a look at the chart. So we got the 390 puts here. So they essentially were cheaper. The premiums were cheaper, right? So they probably made a bigger move just because of the fact they were cheaper and out of the money. And if we look here, let's say we got in at 250. Yeah, let's say 250, and they went all the way up to 360. Let's say 370. Let's just say 360. So 250 up to 360. So $1.10 per share, but because the contracts were cheaper, obviously that's a bigger percentage move, right? So $1.10, and if we look at the delta here, was roughly 47 cents. So if we can grab our calculator here, 110 divided by 250, and we got a 44% gain there. And if we go back to the 93 ones, we can calculate basically, so let's say we got a net 380 and it made a move to 520. This is obviously in hindsight, assuming you top ticked it and you sold at the top, the most profit you could get out of it. So 380 to 520, that's about $1.40. So take $1.40. And that's a 36% move. So a slightly smaller move, but as you can see, roughly similar. So you can't really go wrong with the strike price you choose unless you're going way out of the money. So as long as the volume is there, as we've kind of discussed here, volume is really important when selecting your strike price. That's probably the most important thing. And as you can see on SPY, it's really not an issue because it's probably the most liquid traded option out there. So no issues with the strike prices here. You're going to have pretty much anyone you pick that's close to the money or slightly out of the money. You're not going to have much of an issue. Now, I know for smaller accounts, they like to go way out of the money because the contracts are much cheaper, right? And this is not necessarily the best strategy, even if you're trading a small account. You know, I would recommend trying your best to stay close to the money or slightly out of the money, but not going too far out of the money. So, you know, if the stock, for example, for SPY, we know the range on SPY can be as big as maybe 10, 15 points in a day, and it can be as small as 2 or 3 points in a day, right? So we know the average range is maybe 5 points a day, let's say. So if you know that the average range is roughly 5 points, you know, going out of the money too far, let's say greater than 5 points, maybe 10, 15, 20 points, you know the odds of your trade are going to be much lower, and the time decay is going to catch up as well, depending on your expiration date. So, you know, I don't recommend going too far out of the money. Just try to stay close to the money. And, you know, what I basically do is I try to find the one with the best volume. And if I'm confident that the stock is going to reach one of my targets, I'm going to be selecting the main target. So in SPY's case, you know, 390 was an absorbing zone. It was a clear demand zone. That would have been my target, and I would have been selecting that strike because it had more volume, and it made sense for me that the SPY was going to likely hit that level. So it printed, it didn't even get in the money actually until later in the day, but because it was trading close to the money, it was able to, those contracts were able to go up very nicely. So that's basically the basics of options. Hope you guys found this helpful, and I tried to make it as simple as possible. I know it can be a little bit overwhelming, and with all the options chain and all the all these theta, delta, all the Greeks, but keep it really simple. You look at your delta to kind of determine your risk. Theta is not really that important if you're day trading, especially if you're scalping and choosing longer expirations. But you do want to keep an eye on theta, on time decay, if you're trading those same day expirations or those 1 or 2 day expirations, because it can affect your trades, and you can be in a winning position in terms of, you can be on the right side of the move and still lose money in contracts if you're choosing the wrong contracts and the wrong expiration dates. So I hope this kind of helped you guys clear up what expiration dates to choose, what strike prices to choose, and just try not to overcomplicate it. It's really not that difficult, and it's very simple. But you just have to avoid the wrong strike prices and the wrong expirations. That's the only thing. If you're going way out of the money, like you see some of these gurus on Twitter preaching all these 1,000% gainers, and they're going way out of the money. Those are probably 1 out of 10 odds, right? So you're taking very low odds trades in those scenarios, and most, if not all, their contracts probably expire worthless because they're going so far out of the money. So try to stay close to the money, trade at the money or slightly out of the money. That's my recommendation. And once again, I hope this video helped you guys. If it did, leave a like down below. Lets me know you guys found it helpful and will help me continue to push out more content in the future. All right, guys, have a good weekend. Cheers.